This is the Taxes in Retirement webinar, part one of a two-part series. Our guest speaker will explain all of that in greater detail to really give you some actionable tips this morning. But real quick before we get started, just please look at your screen and notate the part of the interface where it says chats, polls, and handouts. So for the main reason we're all here, planning for retirement is one thing, but effectively managing your tax implications of your hard-earned retirement savings can be a game changer when done correctly. Over the next 30 minutes or so, you're going to learn strategies that are not only going to preserve your wealth and reduce your taxes, but they will also ensure you have set yourself up for such a silky smooth transition into retirement that even your in-laws might be impressed. Our guest speaker today is not only the CEO and senior financial advisor of Tailored Wealth Solutions, but he has been featured in Forbes magazine as a top financial securities professional for several years now. Now in his third decade of wealth management, he has witnessed firsthand just how many of these tax nightmares could have been completely preventable with just a little bit of proper planning. He has a unique, proactive approach to financial planning while educating dozens of CPAs on a truly collaborative tax planning experience where financial advisors and tax professionals work hand in hand to help clients make the most of their retirement. Without any further ado, let's please welcome Mike Testa.
Welcome, ladies and gentlemen. What I'd like you to do, if you have a second, is maybe pull out a dollar bill if you have it lurking around your desk. First thing I want you to do is literally rip that dollar bill in half. And we're going to say bye-bye due to federal taxes, or what I like to call anti-IRS, right? The next thing I want you to do is rip off another third of that dollar bill. And what you're going to realize, that's state taxes. Now, another piece that you might not be aware of that we will cover today, and I'd like it to even make that dollar bill a little bit smaller, is the idea of Social Security and Medicare taxes. And if you're staring at that dollar bill now and wondering, where did it all go? That's, again, the tax thing. And there's this small little piece left that we're staring at, thinking about how this gets us through retirement. And finally, the tax that no one ever thinks about, your kids. They come home early, they ask for their piece of the pie before it's time. And that is what you are left with, staring at that little corner of that dollar bill. Now, because I didn't want to rip up and create a federal offense today, I think you get the picture. So we want to welcome you to our taxes throughout retirement and how to plan for them. You've all made a conscious decision because the first time ever, you're realizing that you might actually pay more in taxes than maybe what was once disclosed many, many years ago when you started this journey. And this is so important because with the changes that are coming from taxes in other areas of the financial life, it has a tremendous impact on you. It is literally taking dollars away from a sound retirement. And why is it even a crucial time to address this? Because you still have time. Every year that this passes is less time to make substantial changes to put more money back in your pocket. Today, we're going to unfold and unpack 4 strategies or items that you will be thinking about as you approach this new endeavor, retirement. And I'll leave it with this, a very popular book, What Got You Here May Not Get You There. Write that down. What got you here may not get you there. And the concept behind this is the accumulation phase is sort of easy. You put dollars away and you wake up one day and it's time to retire. It's kind of easy. What got you here may not get you through retirement because it opens up a whole new door of complexities, which we're going to talk about today. You're going to see the agenda on the screen here. Again, why we're here is to address this very critical and somewhat complex topic. We're going to break down in simple items. We're going to bring you through 4 key components as you see on your screen. And then we're going to talk about some really transitioning this into actionable steps that will impact your life today. We have some other questions that we'll ask the group. We finally have some closing remarks. And last, let's not forget, this is a 2-part series. This part 1 is more of a general broad overview, but we invite all of the parties that have attended today to a part 2 personal assessment, but we'll go into that later in detail. Finally, you might be thinking, why are financial advisors even giving a talk about taxes and retirement? And as Jason alluded to, it's our sole focus. helping clients transition from accumulation phase to retirement and doing it by putting more money back in their pockets when possible through proper tax planning and review. So again, hopefully we cover some great information and join us for the ride. Before we jump in, obviously disclosures, right? Again, seek any real CPA or legal professionals if we start talking about those topics. Again, if you're working with a team like us, we would team up and talk with them alongside. Key notes on the right hand of the screen, traditional IRAs, we call those tax deferred. That means taxed when you take money out later in life. Roth IRAs is money grows tax free. You might know that, unless we're not talking about state taxes in this webinar, mainly because we do these workshops, one national base and all across the country. So getting into those complexities would cause too much time, and we would cover that more in the personal assessment. All right. So where do we even begin?
What interested you primarily in joining our session today? Are taxes a major concern that aren't being addressed? Are you wanting to kind of meet some like-minded tax-focused advisors? Are you a DIYer who just kind of wants to understand how to mitigate your taxes yourself, or is handling the tax part the next phase?
So where are we today? We're living in a new complex world, right? As I mentioned before, taxes in the accumulation phase are somewhat easy, right? But as we transition into this distribution or spending phase, becomes extremely complicated. For instance, there's no more child tax credits once you retire. Most likely you're not getting the mortgage interest deduction, tax-free paid employer medical plans, right? The contributions, matching contributions to 401k plans. So as you can see, when we were in accumulation phase, we actually had a ton of benefits given to us that were tax efficient. But now as we transition and have to sort of own that retirement picture ourselves, it opens up a whole new world of complexity. Things that we'll be covering today that's super important, Social Security. We're all thinking about it. Some of us may be already collecting, but there is still a tax picture behind that. Required minimum distributions. What are they? What do we mean? How do we plan for that, right? Paying for Medicare. We're going to unpack ways that some individuals might experience 320% taxes on not doing the right thing around Medicare. And then finally, we're all going to reach a point in time that our health may start to decline. How do we plan around that for the next generation, that or what we would call legacy or estate, right? So where do we even begin? What is the first thing that you need to know is kind of understanding how much money you actually have after taxes. It's easy to see and look at our account and say, great, I have a 401k. It's got $1 million, $2 million in it. That's a very easy number to read, but that's not the true number. Very easy way of unpacking this. If you have 500,000 in a 401k, right, IRA, similarity type of investment vehicle, we can look at potential tax rates. So what we've shown on the screen here are maximum tax rate. But in reality, if you take federal and state and combine them, you're going to be looking at numbers kind of close to these. And look what happens to 500,000. Now just imagine if that was $1 million or $2 million. The number gets dramatically smaller, let alone you're going to be forced to take this money out depending on your age between 73 and 75. Here's how it grows over time. So here's the picture. We have 3 different tax rates. 0, which we all wish we could be in, right? That would be a very big goal of ours for you. But again, probably not very realistic. A 12% tax rate, that gets palatable. How can we really get down to a 12%? Because that would solve a lot of problems or put a lot of money back into your pocket. And then finally, on the upper echelon, we have the 33% tax rate. What we're trying to transpire here is the impact it has on your wealth, right? You can see from the 3 curves here going out 30 years from now. So let's just call it 60 to 90 years old. Here's the substantial impact taxes will have on your money. And from these two, from the lowest to the highest, we're literally seeing over $1 million, about $1.5, $1.7 million lost due to taxes, just due to maybe negligence, right? Not paying attention to these items. This is stuff we're going to unpack for you today. You might also be thinking now, well, wait a minute. That's fine. I'll pay some taxes. No big deal. Medicare and Social Security, they got my back, right? I'm sure I can hear you all laughing on the other side of the screen here because Social Security is rapidly changing. But let's talk about our first story that maybe many of you will resonate towards. This is about our friend Bill. Bill is a huge concert goer. That's what he enjoys doing in retirement. He trip to see the Grateful Dead, and he thoroughly enjoys himself. We're going to break down how taxes are going to work between a $1,000 additional distribution from an IRA so you can take your next trip. On your screen here, you're going to see two scenarios: before the concert trip, and then the $1,000 taken out to buy a plane ticket to go to the next upcoming concert trip. We're going to walk through these numbers, but I'm going to go to the next screen so you can see the key takeaways here. Again, IRA income of $40,000, right? So we're taking $40,000 a year out of the IRA. The Social Security benefits is $37,500, right? First question you might be saying in your head is, that letter's AGI. What is it? Adjusted gross income. This is the income that gets adjusted for different deductions and so forth. At the end of the day, you're also looking at the number and saying 40 plus 37,500 does not equal 65,538. That is correct, because not all of your Social Security income is taxable out of the gate. Be aware, be understanding of that. So at the end of the day, after deductions, after the AGI and taxability, Bill's really paying $48,988 of VC income of that number. It results in a $5,830 tax. Now, this is what transpires. All of you have probably crossed this bridge once in life. You've called up your proverbial broker. You've requested the $1,000 so that you can take your trip, right? But look and see how this unfolds. But when you make that call, if you never talk to us again, push back on them when they say, hey, just hold your 10%, just hold your 15%, because we're going to show you why it costs you multiples of that. So Bill calls up his broker. He says, let's take out the $1,000. No problem. Going to send it over to you. Hold 10%. You're going to be fine. That's the conversation that happened. But what transpires here is it creates a lot more taxability. So we're going to go to the right side of the picture here. What you notice is the adjusted gross income did not go up by $1,000. Isn't that weird? I took out 1,000, but the adjusted gross income went up nearly 2,000. Well, that's interesting. And then follow that down in the taxable income picture. Again, that number continues out with about another $2,000 increase on the taxable income. And then finally, you can see that tax increase a little over $400. So hold on. What did I just say? A $1,000 distribution cost Bill nearly $4,000 in additional taxes. Now, I don't know if I can do math that good, but 400 on 1,000 is 40%. Okay. So let's talk about this. Let's sit there and think about it. Would you ever think you were paying 40% in taxes? This is a reality, folks. Okay. So as you're seeing on the screen here, what happened is it did push Bill into a new income level, A, and B, more of his Social Security ended up being taxed. So what you see here is you have a tax bill of $407 on a $1,000 distribution. So again, you withheld 10%, $100. No wonder you might be frustrated at the end of the year when your tax bill continues to go up. There's a missing component of tax planning. Again, the idea here is the unawareness of the 40% tax that you could be paying, and the idea that maybe somebody told you you were in a 22% bracket. Little things add up. So be aware of the Social Security tax track. We're going to move on. We're going to talk about the second kind of thing that we would want to know. And that is George and Martha. This is a great little story. It follows on with the Medicare taxes that many of us witness and pay. I call them taxes. We can call them surpluses. We can call them premiums. Nonetheless, dollars out of your pocket is a tax. So George and Martha have Medicare Parts B and D. They have a $322,000 adjusted gross income, which I'll tell you is extremely healthy at George and Martha's age. So we really like this story. And Martha does what any reasonable person would. Her aunt had given her a stock many, many years ago. And ultimately it had grown. There's some gains in it, but she just didn't see how it fit in her personal financial life. And she wanted to gift it to the grandkids. Okay. She wanted to give them some money. So ultimately, Martha called up the broker to sell the $1,000 of stock so she could pass that money along. It resulted in the $1,000 gain. It's a capital gain And many of us might be aware, but a capital gain is typically taxed at 15%. There's a range. We're not going to get into all the detail today, but conceptually, how did the phone call go? I need some money. You have a gain. Don't worry. You're only going to pay 15% on that gain. And what we're also putting in here is a 3.8%, what's called a net investment tax at George and Martha's income level. It's a real thing. So in total, Martha was told she would pay about an 18.8% tax on that gain, or $188. Well, let's show you how all of these dominoes started to push down the castle. Okay. At the end of the day, this $1,000 gain triggered an additional IRMA charge. So IRMA stands for income related monthly adjustment amount. It's your income drives what your IRMA charges are for your Part B medical. Okay. So ultimately, that $1,000 ended up giving a surplus to George and Martha of about $200 a month. Okay. Then let's carry on to Part D. Now, Part D ended up with an additional $39 per month of plan premium. And I'll take a step back, folks. What you're seeing on the screen here, you can easily find on the internet. But at the end of the day, these are the bracketries for Medicare premiums. Okay. Very, very important when you're managing your taxes and your distribution phase. It can get kind of complex. But what we want to hammer home here, okay, what is so critical and just important to wrap your mind around is the idea that when this event occurred, a simple phone call to get a little bit of money, which we thought was a very little tax, $188, ended up costing a combined charge of $2,920 to George and Martha. Now, folks, the other thing you need to be aware of, this tax doesn't come out immediately. The Medicare reviews their income schedules 2 years later. So what does that mean? In 2025, if you make this mistake, you would have no clue that it cost you more until 2027. In fact, 2028 when you actually file your taxes. Okay. So at that point, you're not even going to remember that distribution. And you're going to be thinking, why the heck did any of this money, why is this all costing me more? Right. And at the end of the day, none of you would have assumed that you're now paying 320% on a transaction that you were simply just trying to improve the lives of your family. Right. So here's the breakdown on what happened. We sold stock. We captured $1,000 gain. We thought that would equal about 18.8% tax. What ended up happening is it triggered a whole new income bracket for IRMA, and you now have a total surplus charge and taxes of $3,108.80. Guys, that's 310% tax. Please, I don't want anybody paying that. Be aware of these tax traps. Okay, so you're already probably thinking like, what else do I need to be aware of, right? Before we jump into this, if your head is already spinning, if you're already sort of confused, we want to get you back on track. Down at the bottom part of your screen, you will see that opportunity for a Part 2 personal assessment. This is where we can dive deeper into your unique situation, because again, these are high-level items to review. Okay, so the next thing that you need to kind of be aware of is, how you actually use your money and what opportunities exist to reduce that taxation later in life. What we call this is managing your tax bracket. Again, getting to a 0%, going to be hard, probably going to be obsolete, but manage it to effectively keep it low. So the first thing you might be thinking, you probably have seen it all over social media, is this Roth conversion idea. We're going to cover this very high level and leave you with some palatable ways to maybe go about it on your own. First thing that you need to know, a Roth conversion is the idea of taking your IRA or 401k money, portions of, or the whole thing, and converting it to a Roth. What that says is you will pay taxes in the year of the conversion. However, now that it's in a Roth, it will grow tax-free for the rest of your life. We're going to give a simple story here about Jill, who wants to convert $100,000 from her IRA and how we as advisors would approach that. So one thesis or philosophy is what we call filling up the bucket, right? It's a strategy that you at home can go ahead and do on your own. But again, this is not advice. This is just a concept on how you could approach it. Jill's income falls in the 22% tax bracket. A logical way of approaching this is just fill up the rest of the 22% tax bracket. You know, the tax can most likely be, because you can estimate that. But the second part that you got to be aware of, depending on your phase of life, is what about the dominoes into the Social Security and Medicare, right? So be aware. So number one, fill up the bracket. The second thing that you might be staring at, I pick up on all the time, look at the jump from 22 to 24. That's 2%. I don't think that's a lot of money. Okay. 2% on $100,000, 2,000, right? So if I can convert another $100,000 and maybe it only costs, regular tax, but then again, just maybe 2% more, does it feasibly make sense? But then when you see the 24 to 32, that's a little bit bigger of a jump. You're talking almost 8%. I think that's a little high, but again, work with a talented team to figure that out, what's going to work best for you. What I'm leaving you with here is just conceptually think about filling up the current tax bracket as a soft way to think about Roth IRAs. Okay, so what else can you be thinking about or even consider? Some of you, and I laugh at this because many, many years ago, I'm sure a good handful of you had your arm twisted to buy some sort of life insurance. Back many, many years ago, you probably hemmed and hawed about doing it. Guess what? If you bought the right type, there's a high probability that there's some tangible cash for your retirement. Okay. And what that basically means is that you can use this money tax free and not have it implicate those other items we just talked about, the Roth conversions, the Medicare, etc. At the end of the day, think about your how your insurance policies might play into this. Second, you got to watch for how you sell highly appreciated stock. We just talked about George and Martha. That stock had gone up in a game. They just sold out. They didn't think through how that goes. There's also a second strategy that is a little too long and lengthy to cover today, but there's ways that if you have highly appreciated stock to actually receive some of that cash without paying massive capital gains. Okay. If that is you, if you're sitting in that seat, if you're staring at a couple good investment choices that are now kind of concentrated within your investment portfolio, think about that. How can I maybe start to diversify, but keep my taxes low? And then finally, distribution of your 401ks or IRAs. Folks, it's so simple to just go through the regular routine of spending your cash and spending your brokerage and then your IRAs. What you're doing is just building a bigger tax fund. Okay. So you need to have a really proper distribution strategy that not only mitigates risk and growth and inflation, and that list goes on, but then we'll pivot over to what we're talking about today. And you need it to be able to be tax efficient so that it lasts longer for your retirement. So these three areas are other ways to approach and manage your tax bracket efficiently.
Hey, Mike, can I jump in real quick and ask you a question about the last kind of two topics there?
Yeah.
What would you say is the biggest impact factor in regard to possibly converting some of that 401k or IRA money into a Roth? Like, what would you say is the biggest thing that somebody needs to consider if they're thinking about having a financial professional kind of vet that for them and see if that's worth it?
It's a good question. So I think what Jason's kind of after here is your Roth conversion strategy matters a ton on your age. And why do I say that? Because there's no perfect year and everybody's goals are different. But here's what we're finding. When you're a little late to the game on this, you're 65, maybe even 70-year-old, you can still perform. There's still ways of converting the money. But what I kind of like to be clear with the individuals we speak to is the idea that conversion process is probably not there to benefit them. It's to benefit their legacy. So these discussions need to be had so you know why you're doing what you're doing. If you're under those ages, there's possibly a high probability that you're going to be able to make a conversion happen and ultimately make the money or the growth on that money throughout the next several years and still be young enough to distribute that money without kind of feeling any sort of loss of return, if that makes sense. So the age plays in a huge factor here. And I think that's something that, again, personal assessment is what talks about it the best because we don't know enough to kind of spread that book thin across all the different participants today. That help, Jason?
Yeah, definitely. It piqued my curiosity. Maybe what would be the one thing somebody wants to just like maybe focus on? But that makes a lot of sense because if they're trying to alleviate pressure of that tax bond from their kids at a certain age, it still benefits them. It's just more as far as legacy planning. If it's younger, I get it now. Yep.
So I think that the final thing there is just, understanding that it needs to have a deep conversation. A conversion is just not a conversion, right? We need to have purpose to what we do. And it actually is all backed by a sound financial plan, understanding where you're going and what's going to occur at the different phases of life. We'll continue on to stay the course here on a time factor. Two other things that you want to look into: health savings accounts, triple tax threat. Now, not everyone qualifies, but triple tax threat. We like it. Tax-free money going in, so tax deductible. It will earn tax-free. You never pay tax on the growth. And if it's under qualified medical expenses, you can take that money out tax-free. Triple tax threat. We love them. Okay. And if you're a business owner on here, I could do a whole nother seminar for several hours on the dozens, if not hundreds of strategies to reduce your taxes, and in some cases, all the way to zero. So if you are a business owner, again, I'll call the attention to the personal assessment. I feel very comfortable to say I could probably reduce the taxes by approximately $10,000 just in this year alone. So join us. Okay, so now we're a little later on in life. We've now hit the required minimum distribution age, which is 73, 75 for most people here. We're going to talk about Al and Shirley. So Al and Shirley, they're in a 24% tax bracket. A lot of us can resonate to that. And they just have this giving goal. We all may want to give some money to charity. We're going to show you two ways to give money to charity and one that costs you a lot more. Okay. So $5,000. One thing you need to know is Al and Shirley used to think that like we can itemize these different deductions we have. So they have 15,000 of deductions. They were like, hey, I'll just give it to my CPA and they'll itemize it and I'm going to save some money. What Al and Shirley didn't know is that since 2017, I believe, that we don't even itemize anymore. Most of the time, you're taking the standard deduction for a couple as of 2024, $32,300. Okay. So obviously, that's more than the 15,000. 15,000 becomes null and void. And in this case, we're going to show you again the two ways you can do it where you can create some benefit. You may or may not have heard of what's called a qualified charitable distribution. This is the way of taking monies from your retirement accounts and get it direct to the charity of choice. You have some information on the right of your screen that's super important. First, you could do up to $100,000 a year. If you're given that type of money, you got a great situation. You could probably be saving even more taxes. It must go direct to charity. We're going to talk about that. It will count as an RMD when done properly and not show up on the tax return. And you want to make sure if there's no deduction on income tax. So let's show you the two different ways. In some cases, this is the process. I call the broker. I ask them for $5,000, $6,000, $10,000 out of my IRA account. And they don't ask any questions. They just say, okay, no problem. So in this case, your $5,000 gets sent to your bank account. You then send that $5,000 to charity. It does satisfy your RMD because you took it out of your IRA, but the $5,000 gets a 1099 and it shows up on your tax bill. You will have a tax of, in this case, 24% for Al and Shirley, $1,200. Again, that cost of charitable contribution is $6,200. So guys, again, I want to give the charity $5,000, but it costs me $6,200 because nobody asked me a question. What do you plan on doing with that money, Mr. or Mrs. Smith? That's the question. I'm going to save you $1,200. So by utilizing a QCD, what you see is the money comes directly out of the IRA and gets sent directly to the charity. It still qualifies for the required minimum distribution, but the $5,000 is excluded from the taxable income. It doesn't show up on the tax form. So ultimately, charity gets the $5,000. You don't have to pay the $1,200 in tax. And again, we just put $1,200 back in your pocket, right? So again, congratulations. You took a few minutes out of your day. If you're doing something like this and you've never heard of it, just saved yourself thousands of dollars. Again, consult with your CPA. If you have questions, reach out to us if none of this is very clear. Okay, so we've been through a lot, right? We went through the pre-retirement stage and preparing. We went through the early retirement stage of figuring out the Social Security and Medicare picture. We talked about RMDs and things where we could kind of lower the tax on the RMDs. And then finally, we've lived a successful life. We're maybe in our 70s. We're thinking about the next generation. We're not there yet, but we're thinking about it. So we're going to go through ways that you can protect your money, give more of it if that's a goal. We want to talk a little bit about taxes and how long-term care works, right? So if some of you don't have it or have explored it, in many cases, when you pay for long-term care, it actually could be federally deductible. So again, does this work with your plan? Do you want to pay some premiums, get a deduction, and then later on in life, when you need that money, it's all completely tax-free? A little bit of like a triple tax threat again, right? If you really think about it, tax deductible going in, tax-free on the way out. That's like a Roth IRA. There's no investment vehicle, but you get the concept. The final piece to this is actually choosing how we actually pay for the long-term care. This is the most impactful thing you're going to see today. We're going to talk about our friend Florence. Florence, unfortunately, is at a point in time that she has to go and need in-home care. Okay. We know that it's going to cost about $60,000 a year, and Florence has about $20,000 coming in from Social Security. So the family needs to pay another $40,000 or so a year to keep that care going. Florence's assets look like this. She's got $400,000 in an IRA, and she has this like life insurance plan that has like a long-term care rider where you can get money out for health needs prior to passing away. Little unique. So it's got a $500,000 death benefit and $10,000 a month for long-term care costs. So just review this: $400,000 in IRA, $500,000 in a life insurance policy. Two ways of getting your money. Let's show you which one gives you more. So in scenario one, we would do what any individual would do, right? I have long-term care coverage. I'm going to use long-term care. Pretty simple, pretty like self-explanatory, but we're going to show you why it costs you almost $100,000. You're going through this phase of life. You're just pulling the money out of that long-term care life insurance policy. And at the end of the day, Florence does pass about 5 years in. Okay. So she used $300,000 out of her life insurance policy, but did not touch the IRA. So when Florence is passed, the kids inherit $200,000 of tax-free. That's the life insurance, tax-free. And then $400,000 of the IRA, which is an inherited IRA, which is going to be fully taxable to the kids. $200,000 tax-free, $400,000 taxable. Let's reverse the process. In option number 2, Florence decides to use her IRA money to pay for the long-term care. Now, in many cases, families will qualify for deducting those medical expenses. So if you're taking money out of the IRA that's taxable, you may feasibly end up with a tax deduction for those medical expenses on the tax return. Therefore, you're using that IRA money potentially tax-free. Interesting. Very beneficial. Number 2, we never touched the life insurance policy. So at the end of the 5 years, what are you left with? You have a $100,000 IRA taxable and $500,000 tax-free to you or the kids. Okay. Let's just put it in simple terms. What's the cost of comparison? You choose which one you rather have. You can inherit $300,000 of taxable money, probably cost you about $100,000 in taxes, a third, or you can get $300,000 of tax-free. So again, door to the right, taxable; door to the left, tax-free. I will be at the left door. You guys can join me there if you agree. So think about this in a long-term perspective and make sure you've got a plan to really mitigate these taxes. Something that we didn't even talk about today is this, what we call inherited IRA tax. If you're sitting on an IRA that's over $1 million, there is a high probability your kids will be paying $1 million in taxes when you pass away. A very high probability. If you want to solve how to not have your family erode $1 million due to taxes, this is the stuff that the personal assessment is going to help you with. I know what you must be thinking at this point. Number one, how would I even do this, right? This seems like a very complex lot of information. Okay, it is. And we're trying to break it down for you in a very simple way. So let's just go through what we did, right? We hit the pre-retirement stage. We talked about early retirement, where Social Security, taxation, and maybe even some Roth conversions. We hit middle retirement, all about managing your required minimum distributions. You need to know early on, will your RMD be much higher than your living expenses? And if so, you're being forced to pay tax. It's kind of simple as that. If your RMDs are greater than what you need, you are now being forced to pay taxes on money you don't need to. And then finally, late retirement. That's when you're really starting to think about, hey, how is this all going to transpire over to the next generation? How can I maximize my legacy? So what you want to do, right? The solution here, A, anticipate the different tax traps your assets are going to face as you go through life. Understand the range of taxes you will pay. This is not a gimmick workshop here. We're not trying to tell everybody you can pay zero in tax. If there is actually a way, and I've been doing this for nearly 30 years, if there's a way to get zero, tell me now. Tell me now so I can spread the word. But I do think that you just have to manage and figure out ways to reduce as much as possible. And then your actions play a huge role in this. Passively sitting on the sideline, not getting educated, and maybe even questioning the current regime you are under will all play a role in maximizing your potential. And remember the words I said at the beginning of the workshop. What got you here may not get you there. Different people in our industry sit in different seats, and you now want the experts in the retirement distribution and tax process. As you prepare, the distribution phase can be very complicating. Taxes happen throughout retirement. This is not a one and done concept. It's always going to change. And I think some of you, if you pay attention to the news, Mr. Trump here, he's got this thing in the big, beautiful bill. This is going to be passed towards the end of the year. And that's going to, again, change the whole game. So you need to be on top of this stuff. As we showed, mistakes can be costly, right? I mean, we just went through a few concepts here that were thousands of dollars. Imagine if that hit every year. And then finally, continue to educate yourself. We're really happy that you joined us today. It says that you're really serious on being smarter about this situation that you know is going to play a huge impact on your life. You want to have planning, and you definitely need to get the right advice and guidance. Any other questions that might be going through your mind before we get into our kind of closing remarks?
Like an attendee had asked, she's not Medicare age yet. She assumes the Medicare fees are based on income from 2 years prior to eligibility. She is correct. So anybody listening wondering how that number is calculated, if you're not at Medicare age yet, which is very common, it's 2 years prior to whenever you turn 65, because if you just reverse engineer that, you'll realize the current year, obviously no tax return. So the year before, the last full year will be what your first fee is based on. It'll always be trailing by 2 years because of that, because you're in the current year. You got to go back to the last full year that you had your taxes, which of course would be 2 calendar years before. So just a little bit of logical logistics there for understanding how that piece works.
Let's expand just a touch on that Medicare. If you're going to be doing a Roth conversion and somebody's telling you to do that at 64, right? Or even 62 or 63, you got to remember that's going to play into your Medicare bill. So you got to be aware of these things. The idea is very, I guess you could say, easy concept, but then how does it transact, just as Jason mentioned? So I just wanted to throw that Roth conversion, because they might be thinking, well, I'll do it before I retire, but now that impact at 65, right? So go ahead, Jason.
No, that was going to be my point, is how does that factor into the Roth conversion? So you read my mind on that one.
You know, the final thing I want to leave, I know people's questions, their heads are going, but there's a thing that nobody's discussing. And this is the inherited IRA taxation. You really, really need to understand that picture. Again, if you have $1 million or more, or even around that much, currently in like an IRA 401k, there is extreme probability that your kids are going to be paying 6, if not 7-digit tax bills. That's $1 million in taxes over life. This is not estate taxes. This is not those concepts. This is simply You did the right thing to save for retirement. Nobody told you that it would get as big as it's going to get. And now it's in a very on point. There is ways of solving that problem. So if you're staring at that picture, very important for you to be aware. So as we wrap up here, first, before we talk about a little inside view of what your personal assessment would look like, I want to just thank you again for coming to the event here. Taxes are what is going to make or break a very sound retirement, legacy, and even investment process. We didn't have enough time to cover the dozens of other ways that people are overpaying in taxes, such things like double taxation on their brokerage accounts, things that are unaware. For business owners, dozens of strategies to reduce taxes for things they're currently doing. What I also want to say is you might be saying to yourself, well, my CPA handles that. They sure do. They handle the preparation of the taxes. The challenge that we've seen in the industry is that they have thousands of clients. So imagine thousands of you all wanting a deeper picture review. They just don't have the time. They just don't. A, B, many of the tax savings in these strategies are financial advisor related. So regardless of how great the CPA is, whether there's many of them out there, all of the transactions happen on the advisory side. What got you here may not get you there. You need specialists in this field. As we call your attention to the part 2 personal assessment, there's some things that you probably want to know. You're probably asking yourself, right? So what's even going to happen at this meeting? We're basically just going to talk. We're going to unpack things that you were not really being brought to today about your own unique situation. So we're just going to have a very adult conversation about what is going on today and address your specific topics. What will you learn? You're going to learn a ton. The reason for that is we didn't talk about your unique situation. So you're going to walk away with a lot of information that's very beneficial to you. How are you going to feel after this appointment? Happy and smart. Happy that you took the time to get an expert set of eyes on things. Smart because you're going to find out more ways to essentially, hopefully, give you more wealth in retirement. What should you even be thinking about having at this meeting? We have a document checklist, kind of a set of information, but however, what we know is this is a webinar. You are in different parts of the country. You are not comfortable with our team yet. We totally understand. So perhaps for our first call, don't send anything. Let's just talk. Let's just understand where you stand today. Will we try to sell you anything? No, that's the greatest part about this. Our part 2 personal assessments are completely complementary. We are fiduciary advisors. We do not have any one product to sell you. Okay. We're just going to discuss where you are, what potential gaps you have looking forward. And then from there, we just have an amicable discussion. Where will we do the meeting? So good news. We have different offices across the country. So if an in-person thing is highly needed, we're going to come to you, or if you want, come to us. But really, we would probably be doing this virtually based. And then finally, what happens after the appointment? After that first personal assessment, either A, you got enough information that you do not need any more help. B, there was enough information there to say, holy cow, my planning is missing some very big, important items. Then we talk again. We just simply move on to another meeting. Or C, you completely dislike any of our conversation. You just hang up the phone or log out of that Zoom meeting, just move on with your life. Hasn't happened yet. But again, that's typically the 3 things that happen. Finally, you might be asking yourself, I've attended, I don't know, dozens of these different workshops. I want to get educated. And every time I hop on one of these personal assessments, it's immediately 2 things. Somebody trying to sell me an annuity or somebody telling me to move my money to their institution. Folks, I want to be clear. We do not ask for that. Okay. We have simple, palatable ways to help you create a better financial life without having to move your money. It is an option. You don't have to be scared of having this meeting because you're going to get that same air quote pitch. That's not what we're here for. If we know we can make an impact, we're going to outline how we address that impact. And that's what you're going to walk away with. Okay. So these are very, very crucial things because I know you're going through this. I know you've had bad flavors put in your mouth. These things are super important. So please join us for a personal assessment. You have that on your calendar, pop up over here. And second, you will get a follow-up email that will have more information from today's workshop that might continue to trigger questions or thoughts on your mind. Once again, folks, we want to thank you. And again, if you have any questions, reach out to our team. We again thank you for any time that you joined us today. Jason, any
Thanks,
closing
guys.
remarks?
No, just thank you very much for showing up, everybody, and taking time out of your day. We know this information is kind of dense in regard to how much there is to cover and unpack. So again, if you're feeling like you're confused about a few pieces, don't feel like you can't use the personal assessment just to unpack some of the stuff we've already covered a little deeper. And then even if you have other questions, we get this a lot, even throughout the seminar, may not pertain particularly to tax, but it does pertain to your financial picture, and you want to use your personal assessment to discuss that stuff. That's absolutely fine too. We have a lot of people who feel like, oh, if it's not exactly tax, can't mix it in. We're okay with that. We understand that this is the primary reason for talking, but not the only reason. We are holistic financial planners, which means we cover everything. So there's no reason why that can't happen as well. So just something to consider. And also thank you very much for your time. Very, very grateful you showed up.
Yeah. We're still in a heat wave, as you can see from my face here. So I think most of you are on the Northeast. If you're stuck inside the house, what a great way to spend 30 minutes on a Zoom call. Thank you again, guys. We'll see you very soon.
Take care.